Hello and welcome to the Fat Tailed Thoughts podcast. I'm your host, as always, Stephen Dickens, and I'm joined by my dear friend and co-host, Jared Klee. Welcome to the show, Jared.
Hey, Stephen, how are you?
Yeah, I'm good. I'm good. So this is episode 15 of the Fat Tailed Thoughts podcast. You thought I'd be able to say it properly by now, where we cover the makings of fintech, finance, and money and the markets. So we've got a big topic this week, really the structure of kind of stocks and how they're projected out. Jared, let's get the listeners orientated here. Get us started. What are we talking about
So
this week?
we're looking at the stock market this week, Stephen, and kind of big picture. What is quote unquote normal in stock market performance, and the backdrop for this is this past January actually up until the last couple of days of January, the month was on track to be the worst performing January in quite some time. Last couple of days, the market did tick back upwards. But even still, for the NASDAQ, it was the worst performing start to a year since 2008. It's the second worst on record for the NASDAQ. It's the worst start to a year for the S&P since 2009. This wasn't just a direct downward trend. There was a huge amount of bouncing around that happened in between. So we're going to contextualize both. Is that even normal? I mean, are we just looking at something truly absurd, or is this kind of part of normal market performance over time? And then two, within that context, money management's an enormous industry. And even if it is normal, what does that actually mean if you're a money manager? What are the challenges you now face, the incentives you now face, and are those necessarily still aligned with the people whose money you're managing?
So let's start there a little bit about the volatility. We're starting to see high tech growth stocks have as much volatility as cryptocurrencies right now, which is frankly insane. We're seeing wild intraday swings for tech stocks based on earnings. Massive drops before, massive jumps afterwards. Sometimes drops after great earnings are announced. Just give me your perspective, if you would, a little bit on some of that volatility that you're seeing. Is that just we're in crazy times? What's going on with the macroeconomic climate? We're seeing inflation. We're seeing tensions on the global stage, Ukraine and Taiwan. Is it just a microcosm of all that thrown together, or is there something more structural in your mind?
So it's always a bit of both. But the place to start a conversation like this, Stephen, is the now overused by animal spirits. And we can take two different concepts from the Benjamin Graham, Warren Buffett world. Graham has a term, a quote. They says in the short term, markets are voting machines. In the long term, they're weighing machines. And what he means by that is, and I love that quote, in the short term voting machines, it's a popularity contest. People get excited and they vote it up. But in the long run, it's a weighing machine. It always comes back to the fundamentals of, is the company valuable? Is it growing? Is it trading at a reasonable discount to the price, a reasonable discount to the value of the actual company? We take a different concept, complementary from Buffett's world, which again, actually, if you go back far enough, does come from Benjamin Graham as well. He is this hypothetical person called Mr. Market. And Mr. Market, on some days you want to buy stocks from him, and he's wildly excited about everything. And he says it's going to cost gazillions of dollars to buy stuff. And then you come back to him the next day, and Mr. Market is terribly depressed. He's selling the same things to you for a 50% discount, for a 75% discount. And it's a helpful frame of reference, because if we look at the companies, Stephen, Facebook, for instance, last week announced earnings and sold off 25%. Facebook wasn't a different company 10 minutes before earnings announcement than it was 10 minutes after, and yet we've wiped off close to $250 million in value. Similarly, Amazon, which posted wonderful earnings, finally publicly announced what their advertising revenue is. They're not a different company after earnings than they were before. So there's a huge element of emotion that goes into this that drives the volatility. That said, of course, there are macro changes happening under the covers. Interest rates are changing and inflation changing, etc. But those have been there. They'll continue to be there. They do change over time. Short-term fluctuations, hugely driven by emotion in the context of true longer run macro changes as well as company specific ones.
So the sell-off that we've seen probably over the last 3 months, you're seeing that as maybe just a return to sanity. We've seen a huge growth, particularly in growth stocks, over the last sort of 18 months. Are you seeing the sort of last 3 months of that as the sort of sanity around earnings, sanity around valuations, PE ratios, kind of reaching back to where it's less frothy, if you will?
So I'm not good at overall market predictions of where it will go and what a quote unquote correct valuation for the market is. Certainly under the covers, one of the big drivers we're seeing, Stephen, is changing interest rates, and the Federal Reserve has been now projecting multiple in expectation multiple rate rises this coming year and more to continue next year. Of course, that may change as inflation and employment, et cetera, change, but currently on track to see rising interest rates. That's a critical place to start the conversation, Stephen, because we've been in a near zero interest rate environment since about 2009. That means that the opportunity cost of capital, the risk-free rate has been damn near zero. So as a result, a company that may trade at a many times sales and many times earnings, you just don't have that many other places to go stick your capital where you're going to get a reasonable rate of return. So as a result, valuations tend to go up. If we just come back to how much cash is the company delivering, valuations tend to go up, meaning you pay more per dollar of cash they produce because you don't have other places to go stick the cash. And if you were going to go do this in Excel, we'd talk about the discount rate and other ways of framing this. As interest rates rise, as the risk-free rate goes up, that becomes a more and more and more attractive place to go invest your limited capital. As a result, a company that's trading at many times sales, it's not as attractive anymore because you have other places you can go get reasonable rates of return. So certainly there's an element under the covers of we now have other places to generate return, therefore these are less attractive. But again, the emotional ride that we all go on is we get excited about companies and then disappointed. When you look what's happening, Peloton being a very good example, people got wildly excited because everyone's going to work out from home during the pandemic and so on. And the price of the company skyrocketed, and now it's come way, way, way back down. Frankly, almost where it was pre-pandemic. Now, I don't have an opinion on whether the high point or the low point is the right one, but I can tell you a company going up 400, 500, 600% and then crashing back to where it was. I can almost guarantee you neither one of the ends of the spectrum are the right one. It's probably somewhere in between.
Well, and that's a good segue, actually. Part of the letter, and we'll put that in the show notes below, was this kind of what is normal. So let's maybe spend some time there. You did a fantastic job in the newsletter of kind of describing from a historical perspective where some of the sort of medians and means are and kind of what is that normal stock. We sort of tend to talk about the returns are 10% year on year. People take that view, it becomes kind of popular marketing collateral material to get people to invest in the stock market. But I think I was surprised in the newsletter around that's kind of where I expected it to be at the 10%. But it was the deviations away from that was quite surprising. So maybe take us there first and talk a little bit about this concept of this normal and 10%.
If you read any literature, I mean, Wall Street Journal, you go look at, say, how a nonprofit goes and pegs and say, we've got an endowment or university and we're going to generate returns. You often see projected returns somewhere in the 7 to 10% range a year. Where that number comes from, long run returns of the stock market dating back to 1920s or so is about 10% a year. The 7%, the lower number there, comes from an inflation adjusted version of that. It's closer to the 7. That seems to be, if you take a series of the last 100 years and you take a series of non-overlapping 30-year periods, it's also right around 10% a year for each one of those 30-year periods. That doesn't mean that's going to be what it is in the future, although I think there are good reasons for it. But historically, we'll call it 10%. The challenge with that, Stephen, is our intuition when we hear average of 10% is typically comes back to what we'd call a standard distribution, a normal distribution. What that means is take height, for instance. Height is height of men, height of women is a really good example of a standard normal distribution. 66% of the distribution is within one standard deviation, meaning in the case of height, it's about 3 or 4 inches around the average. Men across about 20 countries average about 5'10". You get 68% of the population is within 3 or 4 inches of that one standard deviation. You go 2 standard deviations out, 6 inches, 6 to 8 inches around that 5'10". You've now got 90+% of the population, and we're 3, 4, 5 standard deviations away. Challenge is the stock market returns are not in any way normal. Not only do they not cluster around the middle like that, when you then go look at the shape of the curve, it's fat-tailed, meaning you have an abnormally large number.
I'm thinking that maybe where the name of the podcast came from.
Just perhaps, Stephen.
Just maybe, perhaps there was a trend emerging here in the name of the podcast. Sorry,
Exactly.
Jared, I interrupted you.
Exactly. But it doesn't, first off, the average doesn't cluster around 10%, even though that is the average. And the reason being is that you have these fat tails, meaning you see this abnormally large number of returns on an annual basis, way above 10% and way below 10%. That throws massive tricks with our intuition. So even though the average is 10, if you actually go and look at the underlying numbers, only about 5% of the years have been within 8 to 12%. Just for context, that's the same number of years that we've had 40% or more in a single year. I want to state this. The average is 10%. We've seen 5 years in the last 100 where the stock market has returned between 8 and 12% a year. We've also seen 5 years where the stock market returned over 40% in a year. I mean, this is averages giving us very little intuition about what the market actually does from a year-to-year standpoint.
And that your point here is we hear about returns over the 30-year period, the 100-year period that you talked about. Depending on whether it's that up 40% or down 40% year that we're starting from, it can be very material to how much it is over a typical investor's period of time. I mean, I'm not investing for 100 years, unfortunately. I've probably got another left, so, and that wasn't the audio breaking up. I'm just not going to tell the listeners how old I am. But seriously, you're investing over a 10, 15, 20, 30-year period. Where you start and that time horizon is material, I think, was what I took away most from the newsletter.
It makes an enormous difference. And to quantify, if you started, let's just take the last 20 plus years, we'll call it 21st century, Stephen. If you started investing in the year 2000, well, the 90s boom didn't actually end in the 90s. It ends in the year 2000. You basically start investing at the peak of the 90s boom, and then it immediately crashes. If you started investing January 1st, 2000, you would have about doubled your money investing through the end of January. If you started January 1st, 2002, you would have tripled your money. If you started January 1st, 2003, you would have quadrupled your money. So small differences in time. 2000, you double. 2003, you triple. 2004, you quadruple. Make material changes. That said, again, if you look at that 100-year horizon, it is still about 10% a year. But be wary, and this again, coming back to the average, you're going to see huge amounts of bouncing around in between. Most years, almost none of the years, should you expect 10. It's if you drag it out over really long periods of time.
And I think that's the calibration that we're not good at as humans. We hear an average of 10%, and we, as you say, expect it to be clustered around that. What we're seeing is a drawdown and the sort of panic of the 20-30% that we've maybe lost. That's not unusual and that's not normal, I think, is your point.
Correct. This is your Thaler and Sersky's behavioral economics. We operate with these heuristics, these rules of thumb that work pretty damn well most of the time. I mean, let's just go back to height. We don't see anyone who's 6 inches tall, and we don't see anyone 20 feet tall. Everyone's about the same height within a fairly predictable way. Again, if you see the how much a car costs, same thing. We can go through most of our life in a normal distribution as a pretty good expectation for how things are distributed. So when we run into something like stock market returns and we hear average, we expect normal distribution, and it's critical, absolutely critical to ask the question, is that reality? And the answer here is no. Fundamentally, no. And it's a topic for a different newsletter. A lot of the traditional valuation methods, for instance, deep in the bowels of how the Black-Scholes model works, it assumes a normal distribution for volatility. Sorry, it's faulty. As a result, what happens is in most market conditions, we'll call it the day-to-day, it actually works pretty well because for some sample sizes, it is normally distributed. The problem is that completely ignores events like 2008 and 2009, that ignores events like this past January. If you're investing over any reasonable period of time, those tend to have a massive effect on what you're doing and your returns. So that assumption that things are normal, we'll call it, works 75% of the time. Yeah, that other 25% of the time is rather important.
So that gets us onto the sort of second part of the conversation here, this weirdness about reporting. You mentioned it in the newsletter, this sort of how this let's call it deviation from normal, maybe that's not the right word, but the deviation set of words, but deviation from normal kind of moves into people who are paid and structurally focused on driving these markets, hedge fund managers, endowment managers, those people whose job it is to deliver that 10%, that mythical 10% year-on-year growth for the capital that under their control. So maybe just talk to us about this kind of weirdness of reporting that you highlighted and how that leads to some of the incentive structures.
It's a really, really hard problem to solve is the place to start. The example we said, if you start investing January 1st, 2000 versus 2002, we've embedded this into how we measure returns for money managers. We almost arbitrarily decide to measure a money manager's return on an annual basis, January 1st to December 31st. What that means, Stephen, is even if you did phenomenally well last year, or very well over the last 342 days, it doesn't count for anything. All that matters on measuring how much you're going to get paid this year. What goes in the annual report that you present to your investors is what happened over the last 365 calendar days. That's problematic. And it's problematic because if you start the year in a hole, all of a sudden you've got a whole bunch of bad incentives to dig yourself back out of that hole. And those incentives are not aligned with your investors.
So we were talking about it before the podcast started. Our dear friend Kathy Wood, who's in that hole and's got a spade and continuing to dig her way down as opposed to the way up. I mean, joking aside, fantastic fund arc innovation. If anybody's wondering, this is not investment advice. Please don't listen to anything I'm giving you as investment advice. But if you were to track some of those metrics, 2020 as a reporting year, maybe even before that, was a darling of that space. You look at where that fund is over the last 3 months, and I try not to look, but I do. You look where that fund is. I think that's a great illustration of the work that Kathy and that team have got to do to dig themselves out, and how they've got to get back to showing what we expect, at 10% plus. It's a perverse set of measures, and it's a perverse set of incentives to try and drive those behaviors. So maybe, as I always try and do, take the abstract and turn it into a sort of land it with a particular person. We're not talking about Kathy specifically, but she's a great illustration of those types of behaviors that we're talking about. Can you maybe elaborate there a little,
So,
and talk about it in that
two big
lens?
ones. There are two big ones built into hedge funds and other places. So let's start with the beginning. You always have a principal agent challenge can become a problem, but challenge with a money manager. And that's not a comment on money managers being good or bad. It's as the principal, as someone investing money, I work with a money manager, the agent who invests on my behalf. And core to that is, how do I align the incentives so that the agent, the money manager, is getting paid for growing my capital, and doing so without taking on too much risk, without going outside the confines of whatever it is we agreed is the world of stuff they should be investing in. So over the years, the hedge fund industry, and it starts there typically because it's cutting edge, and it then trickles through other forms of money management, have created a number of ways to try and solve that challenge. Two that I want to bring in here, they're good ideas, but they have real flaws. The first is the hurdle rate. So typically a hedge fund manager is going to get paid two different fees. This is a little different than your traditional RIA type, your registered investment advisor. A hedge fund manager is going to get paid a management fee and an incentive fee. The management fee, historically, it's been called 2 and 20, 2% of assets under management. So just for waking up in the morning and continuing to manage the money, they get paid 2%. And then they get paid 20% of profits. Your traditional money manager for, say, your family's wealth manager is probably only getting paid a management fee. Once you get, we'll call it the big boys, institutional money, they take on a profit fee. And in theory, they're able to do so because they have specialized skills and they're able to generate a higher rate of return. And that's effectively a fee you pay for access to that higher rate of return. So the management fee is straightforward. We can quibble over how much is the right amount, but put that to the side. You get that for being there. We can say, though, that is not aligned with investor returns. You get paid that if the market does well. You get paid that if the market does poorly. Put that one to the side. The profit fee, the incentive fee, you really want to make sure that's 20% of profits is a huge chunk. What we do to align that is two big ones. One is called a hurdle rate. So a hurdle rate can be fixed or it can be moving. So that incentive fee only kicks in above a certain rate of return. So you can say, all right, I only get paid the incentive fee above a 10% return a year. And then I get paid on everything above that. The other way of doing it is you can peg it to a benchmark. If you say, I as a fund manager am going to beat the S&P 500 this year, and every year, I only get paid on profits above the rate of return of the S&P 500. Now, you can actually take this to the extreme. If you go back to Buffett's original investment partnership in, racking my brain here, 1960s, he got paid no management fee, and if memory serves, it was 40% of profits above what was then the equivalent of the S&P. So you can take this to the extreme and put your money where your mouth is. The challenge with that, Stephen, is we see that's measured on a year. So if you start the year like January and you have an incentive fee, you're incented now to swing for the fences. And what I mean by that is, if you've got to hit a minimum 10% return and you start the year down -5, not only, you don't just have to make up 15, it takes more than a 5% return to get back to even. just for just to think about it. If you lose 50%, you've got to make 100% to get back to even. Same thing happens at smaller numbers, that the numbers just aren't as aggressive. You've got to generate more than a 5% return to get back to even, and then you got to generate the 10% on top of that. That's really hard. So what do? You take massive risk, you take on massive amounts of debt, and you swing for the fences. Now, the downside risk for the money manager is they miss. All right, they close up shop and they start with a whole new set of investors. The upside is they look like a hero. That is not the incentive alignment you want with your investors. Your investors want you to stay within the confines of the risk, the returns, etc. And yet this mechanism set up for alignment is now actually driving the very abuse you were trying to avoid in the first place.
It's a disproportionate amount of risk for what you actually want to do. And is that because we've picked that arbitrary start date of January 1st and December 31st? And if that was more of a rolling measure than a hard measure, we'd be in a better place. Is that the takeaway? Or
you got it, Stephen. And there are ways we could talk about longer measurement periods. We could talk about something. We can lock up capital for longer. We can have what's called a permanent capital structure where you invest and you're never entitled to your principal back. You just get the excess profits. All of those come with drawbacks. The longer measurement period, what if we go into a 2-year recession and it's a 5-year measurement period? Well, you're kind of stuck in the same place. The permanent capital, clearly you're giving up access to your capital. You do have, and most money managers don't have the trust of their investors to do that in the first place. Even if they did, few investors have the ability to just basically give up access to their capital for an indefinite period of time. Stephen, the other mechanism that we use and is similar drawbacks was called a high water mark. So a high water mark is what it sounds like. If you have turned, say, $100 of investor money into 150, and then the next year it drops down to 120, you don't get paid any of the incentive fee, the profits, until you get it at least back up to 150. And then the normal payment starts kicking back in. Again, Stephen, you've got this massive problem of if you've dug yourself a deep enough hole, you're incented to swing for the fences because you're not getting paid anyways. If you miss, you simply close up shop and you go launch a new fund. And that is, unfortunately, we see that happen in kind of the washouts of 2008, 2009. We saw many, many fund managers simply close up shop and say, sorry, I'll return what's left. And 3-4 years later, we see them back out on the street raising money again. And just like we talked about, you can peg the start date January 1st, 2000 or 2002. You go look at the materials they put in front of investors, they pick start and end dates that makes their performance look spectacular, when the reality is that if you had picked more appropriate dates, you're going to get a very different picture.
And I think that weirdness of reporting, it's very easy to manipulate. If you're trying to sell your fund, it's very hard to pick the right reporting period if you're trying to assess the ability of a fund.
It's really hard. This is, and there's no good answers. And Stephen, even well-intentioned, this can happen inadvertently. If you happen to start as a fund manager, you happen to time the bottom of the market because that's when you graduated university and you started or what have you, you may look spectacular. You may think you're spectacular. And without a really long sample set, really long time period through many different economic conditions, it's really difficult to know whether or not you were good or lucky. That this is not an easy problem to solve.
Yeah, if you'd have started in, say, 2010 and run it for 5 or 6 years, you'd have looked fantastic just because of the starting period, not because you actually were fantastic, is your point.
Correct. So one place we see this pop up, Stephen, and it's a very deep topic, is the U.S. has a massive challenge with underfunded pensions. Estimates range from anywhere around $1 trillion to $4 trillion underfunded. What that means is the pension has said we are going to pay out our members X number of dollars over the coming years. We've guaranteed benefits to them. The assets we have under management to fund those is some fraction of what we owe. So we owe $100. We've only got 50 in the bank today. By the way, Social Security is the other one of these, but at least the government has the ability to tax. Pension doesn't. So the pension has to assume a rate of return over the next however many years. We're going to owe 100 over the next however many years. We have 50 today. But if that grows at 10% a year, we'll be able to meet those obligations. Well, under the covers, the pension fund managers, we have the same incentive problem. Hey, we had a bad year. I didn't get my bonus this year. I'm going to swing for the fences next year. And if it doesn't work out, I'm just going to go somewhere else. That misalignment of incentives, there are many challenges with pensions. What we're talking about here, the $4+ trillion shortfall in pension funds, a lot of that sends back to the same incentive challenges we're talking about in the abstract with hedge funds. And that is a very real crisis facing the country over the next 50+ years.
So, for once, I think we're getting close to wrapping up somewhere towards 30 minutes, which I'm just frankly stunned by. I look up and we're 31 minutes in, and I'm asking you to summarize, not 37 minutes in like we normally are. So I'm going to just put that as this is one of those outliers for the podcast where we actually hit the time limit. Just summarize us up for a sort of 30 seconds, if you would. What are the key takeaways? What should we be thinking about? It sounds like normal and 10%, but how would you phrase it?
First thing, when you look at the market, averages don't give you a lot of information about what the market's doing on a day-to-day or year-to-year basis. The distribution is very, very different. That said, the long-run returns from the market are fairly robust at plus or minus 10% a year. So with an appropriate time horizon, you should generate a reasonably attractive rate of return. That said, in the short term, you can have lots of problems. You can have problems because you happen to start in a year where the market was high and we went into recession and the market crashed. Lots of stuff can happen in the short term. The worst thing you can do is contribute to that bouncing around by following the emotional toil and selling when you're excited and selling when you're depressed and buying when you're excited. The answer is, if you don't do anything else and you're investing in the stock market, continue to have faith in, well, the companies are producing products, they're generating sales, they'll be valuable over the long run, and then interim volatility bouncing around is just that, bouncing around.
And I'll use this to summarize. I heard recently that the best investors are the ones who've lost the password to their investment account. So that's maybe our investment advice as we wrap up.
I love that. Lose your password.
Lose your password and don't touch it. Okay, so you've been listening to the Fat Tail Thoughts podcast, brought to you every week by Jared Klee and myself, where we break down the mechanics of money, fintech, and cryptocurrencies. Please click and subscribe on the show on YouTube and on your various podcast channels. We're trying to grow something here. We're 15 episodes in, and we appreciate it if you can share it on your networks. We'll be back next week with a similar show. We look forward to speaking to you then. Thanks very much for your time.